Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne Man with David Ingles.
Happy Friday morning. Our top stories today. Treasuries under pressure with U.S. retail sales data prompting traders to trim bets on a Fed rate cuts this year. Now, oil holding on, so as you can see on your screens here, gains on fresh tensions in the Middle East. Now, the PBOC vowing to support this economic recovery ahead of data likely to show that China's pre-stimulus growth at the weakest pace in 6 quarters. And chip stocks in focus across the region after TSMC's strong results reaffirmed this robust AI trade, underscoring hardware demand.
Yep, TSMC, that's the one to watch after those ADRs reached a record overnight and really kind of helped us renew some more optimism on this whole AI trade post ASML. So that's one thing we're watching very closely here this morning after they did guide higher when it comes to the revenue side of things for 2024, I should say. Also talking about CapEx could likely be higher next year compared to this year. So certainly that's lifting the TAIEX here this morning. We're up about 2.5%. But on the macro front, it's really about the strong data that we got in the U.S., whether it was the retail sales, the labor market data that we got. And that's why you're seeing treasuries seeing that retreat. We stabilized a bit, but that's why you're seeing yields pick up in Australia and even Japan here this morning after what we saw, right? Hotter retail sales numbers. So, the market's once again repricing some of these Fed cut bets now when you're talking about maybe still an 80% chance of a 25 basis point cut in November. But the odds of a 25 basis point cut in December has been reduced. You pair that with an ECB cutting for the third time this year, and the market seems to think that it was a dovish message from Christine Lagarde that maybe we could see a 50-50 chance of a 50 basis point cut as early as December. So that's why you're seeing euro dollar a little bit heavy here at 108 levels. And that's why you're seeing dollar yen back above 150, which is a key psychological level. We're already hearing of some verbal intervention from Japanese authorities here this morning. U.S. futures are flat right now. We are seeing equities slightly gaining, but certainly we're watching very closely what happens in the Middle East. So Israel killing that Hamas leader. Certainly that is one thing we're watching when it comes to oil markets. Gold also reached a record high on the back of these Middle East tensions as well. We're watching a little bit of rebound in iron ore. There you go. Let's get to the chip story, though, right? So TSMC seemed to be surprised the market and still in some ways, right? We're seeing a 6% gain in the TAIEX, well, not in the TAIEX, TSMC, which is lifting the TAIEX. But we're also watching some of these TSMC suppliers and how they react to all this. So the likes of Xingtech, I think they get 3/4 of their revenue from TSMC. That's up some 2% as well. So all these sort of fears that maybe the market misjudged the whole AI demand picture after ASML, seems like TSMC are easing those fears this morning. The approach to the open is this. We're taking a look at the data dump that's about to happen first we got the new home prices coming out the bottom of this hour, then the top of the hour. It's a September activity day that we're looking at. Are we going to see enough of a slowdown, Dave, to justify for more stimulus? I think the market's going to look very closely into those numbers today.
It might sound sort of ironic coming from us on the China Show, but I would actually ignore the numbers coming through later today.
The market has.
Well, the market has, simply because we've had a lot of forward-looking indicators already coming out from authorities, right? So I guess in many ways, the question is, apart from a reset on economic models and projections, what other utility do these numbers have looking at already this policy put out of the PBOC, right? So in
more
the last...
today, too.
Well, today, in the last 30 minutes, right?
Yeah.
A deposit rate cut, number one, across the major banks. Number two, they're putting out some of the takeaways from the recent meeting with the Housing Authority back on Wednesday. So, in many ways, implementing the swap program to boost the equity markets. And I think what's interesting is when you look at the markets, right, we've gone up 40% and we've scaled back almost 50% from the top. MSCI China currently, and we have a day left, about 5-day losing streak there. So activity numbers, home prices. Arguably, the home price data would be, I would say, even more important than the activity numbers themselves. Earnings, we're starting to move into that as well. So listen for guidance. CATL, Zijin Mining, Yvonne talked about gold and where we are there as well. We have a 40-year bond sale today and jobs numbers coming out of Hong Kong. Now, speaking of numbers, why don't we look at the estimates for here? So GDP numbers 4.5%, weakest in about 6 quarters here. And yeah, this whole flurry, this reminder, I guess, Yvonne, when you look at these forecasts of why we're here and talking about the stimulus.
Why we're seeing what we're seeing in terms of this concerted effort from policymakers to try to at least do something. So there you go. Retail sales, that might be the one that we're going to watch very closely here. Continue to see weakness in the consumption sector. So you might see some improvement from the prior month, but then again, still looking pretty weak right now. Property investment still in negative double-digit territory. For more, let's bring in our MLS strategist, Mark Cranfield, to walk us through. Before we get to China, Mark, I got to tell, the macro data we've been seeing from the U.S., for example, right? When you have a backdrop of dollar-yen getting back to 150 levels, the dollar certainly has this sort of renewed strength here right now. And the Fed repricing that we're seeing across these markets, are we likely going to get another cut by the end of this year?
I think November is pretty much a done deal. I mean, the Federal Reserve, they know how to read markets. They know how to engage with people. And for them not to do something in November, when they'd more or less promised that that was going to be the case, would be just too dangerous. It would be too destabilizing. And you'll get a really unnecessary volatility. And especially very close to a US election, it's not going to go down well at all. What is happening, and that's where you can see from the way that the derivative curves are pricing, is that December is becoming a toss-up. It is certainly if we get a continuous flow of decent US data, if we get more beats, particularly anything related to jobs, if we get these weekly claims which show that the earlier weakness we saw in the employment is passing and it's back on a strong footing, and we get more employment data which shows that the jobless rate is only around the 4.1% level, that will really make it difficult for the Fed to go with a cut in December. That is the one that traders are now betting there's a chance of a pause. If it's going to happen, it's going to be in December. And we'll be watching what Fed speakers have to say as well. And of course, the December meeting will fall by then we should clearly know what the election results are all about in the United States. And the Fed themselves may have a little bit more of a gauge of what fiscal policy is going to look like for the year ahead. So the discussion for this, they certainly will have a hot discussion for November, but the discussion for the December meeting is likely to be the most lively of all this year for the Fed, and traders are really placing their bets on the possibility that the Fed does nothing and takes a pause for a while.
Well, I mean, Mark, which might be a good thing if you take a step back. I think we have Neil Kashkari and Chris Waller set to speak on Friday. That takes us to the ECB. They cut, as Yvonne is pointing out, third time, and there's now a 50% probability they'll go 50 in December. Well, the reason I say that, do you think the setup for equity markets actually looks good going into the next 2.5 months as we close out this year?
Well, you have a supportive case across the G10, really. I mean, apart from the exception of Japan and Australia are still on hold. But in general, the major G10 people are all looking to lower rates. The Bank of England has started. There's probably more to come. The ECB has got more to come. The Fed is surely going to cut rates again, maybe not at the pace the market wants, but everything is heading in the right direction. So and plus you've got China on top of that also easing policy as well. So from a global point of view, people will be expecting that it will feed into more positive growth for next year, that the monetary policy conditions are extremely supportive for risk-taking. Equities are right at the top of the food chain when it comes to risk-taking. So the backdrop on a macro level is certainly very good. In the short term, people still have to deal with the US election. There could be some road bumps along the way there. But yes, as you say, you can't fault the major central banks around the world. They are doing what needs to be done to make a very positive landscape for people that want to take risk.
Mark, have a great weekend, sir. Mark Cranfield there in Singapore for us, our MLive strategist. As Mark was speaking there, so we talked about the outlook for risk assets. In the meantime, well, at least alongside this, let me just clarify that spot gold is now actually at a record high here amid, well, for one, I guess, haven demand. You also have some structural flows going into gold as well. You know, the quiet bull market, as they say this year, up 40% over the last year or so. Joining us here on set is George Maris, CIO, Global Head of Equities at Principal Asset Management. Happy Friday. Nice to see you, sir. Nice to see you in town.
Great. David, Yvonne, thank you for having me.
The outlook for equity market seems to be supportive, although you have the likes of gold reminding us that there are risks out there. How do you how do you position over the next 2.5 months, I guess, is the question.
Liquidity drives markets, right? And I think liquidity is ample and it's growing, and that's going to be a supportive backdrop to risk-taking. I think you see the ECB being very aggressive. We see the PBOC, the Fed, flooding markets with liquidity, and we've also seen very supportive fiscal policy. Even the BOJ, which is going the opposite direction, which is hiking rates, is really doing so in a much more measured fashion, especially after the yen carry trade unwind drama from this summer. Lots of liquidity allows lots of risk-taking.
The volatility in the bond market, though, does that concern you in any way?
Oh, without question, right? The bond market is the cost of money that's fueling it. That fuels certainty with respect to how you feel about the world. At the beginning of the year in the U.S., you had a notion of there were going to be 6 cuts, and then it was no cuts, and then it was back to 100 basis points, and now we don't know, right? We did 50. The U.S. data is robust. Inflationary pressures are persisting. We don't know where that is. That does create some instability.
The appropriate equity exposure at this point in time, given all of that?
So I am constructive on equities. I'm constructive on equities globally. We've seen a concentration into the U.S. Mag 7. We've seen flows into India and Japan over the last few years.
Yep.
I think that rotates out. That's supported by the massive liquidity happening globally. Okay. That will cause a rotation into risk assets, outside those concentrated markets.
You focus on the U.S., you think, or do you think the whole EM story has changed since we've seen the stimulus splits from China?
I'm someone who thinks that this will rotate more broadly.
Okay.
I think EM could very well work. China is a huge component of what EM is. Now, EM is not monolithic. It's not just China. It's a lot to it. But certainly the sentiment around China drives EM thinking, exposures, capital deployment. The proactive steps that China's been taking, really for the past year or so. And again, every time it does it, it feels like there's a chorus of, well, it's not enough, it's not enough, it's not enough. I literally can't keep track of what they've done this week. They keep pounding away at this. I think it does change the narrative, the sentiment around not only China, I think that spreads across emerging markets. And so long as the dollar doesn't spiral in terms of strength out of control, I think that's a constructive backdrop.
This market's been cheap for a while, and I think the last time you spoke with us, I think you were speaking with Sherry, if I'm not mistaken. You described China as a leap of faith, if I'm not mistaken, back then. Do you still think it's a leap of faith? That was about 3 or 4 weeks back, I think.
Yeah. So it is. You have to trust that the policymakers are going to do whatever it takes, right? It's the Draghi moment of 2012. It's Bernanke in the end of 2008, 2009. Are you going to keep doing things? And I think we have to remember a little bit in the great financial crisis, whenever the Fed talked about a bazooka, the markets, now we always think like that was massive. Back then we laughed like that's the bazooka, that's nothing, and markets continue to sell off. And now we're talking about the Chinese policy bazooka, and what's happening? It ripped up. Now we're seeing continued selling pressure. It's been a very tough week for Chinese equities. There's that typical level of market skepticism that happens every time you have these big inflections. We have to believe that the policymakers understand that there is economic structural change that has to happen, and that given the malaise over the last several years, this is an important inflection point.
And what's the best way to build that exposure now in China?
I think Chinese-related equities. So certainly, whether it's A shares, whether it's H shares, whether it's in economies tied to Chinese consumption activity, like there's a lot of Korean companies and Japanese companies that are certainly tied to Chinese manufacturing and as well as domestic demand. I think that's a really interesting component of ways to play that resurgence.
You mentioned earlier on, and just back to the U.S. component of the equity rally, the Mag 7, right? And I think TSMC gave us a reminder that maybe we should rethink this broadening out of the rally. How do you think about the Mag 7? These are good companies. Are they still bad stocks, though, is my question.
First of all, they're great companies. The question of whether or not they're bad stocks is a lot harder. And here's why. Over the last 100 years, we've actually had many times where you've had this kind of concentration in markets. Yeah. It's not the first time we've had this level of concentration, and it's not the most the market's ever been concentrated. Every time you've had that, though, you've had a pullback, and it's made a lot of sense to pull away from that. The difference here is every other time, those companies weren't generating profits en masse. Those concentrated companies didn't generate earnings. Here we have companies generating massive earnings, right? We've got over 20% free cash flow margins. It's twice the level of the aggregate market, right. And they're investing and growing. So it makes it very dangerous to step away.
And they're giving back cash as well at the same time.
That's right. And what we just saw from Taiwan Semiconductor is the winners win, and they win by more. The ASML report wasn't a sign of AI being weak. It was a sign of the pressures that Intel and Samsung are facing, and they're being competitively disintermediated by the giants like TSMC. So we're seeing powerful network effects that make, not being exposed to the Mag 7 dangerous.
And is it still, that's the best way to play it, is the shovels and dirt, the infrastructure plays around AI and the data centers? Is that still the best way to play it right now?
For right now, it is. There'll be a component where what typically happens is you get overcapacity, right? We overbuild. There's too much. I think so. You've got to be cautious in terms of how the setup is over the next few years. Right now, it's great. Probably over the next 10 years, it'll be great as everything kind of, you get to equilibrium. So I think it's a really good way to play. But because the economies of scale are so great to the winners, it makes having exposure to the absolute top of the food chain, a thoughtful long-term experiment, even if there can be an over-enthusiasm in share prices at the current state.
It seems that, so we've established that equities is the place to be, and I'm wondering right now, stick your neck out, if tactically from here to, let's say, the next 6 months, is it an MSCI China trade? Is it an S&P 500 trade? Is it something else?
I'm very constructive on China. I've been constructive on China for about the past year. It's a market change in perspective from a lot of that has to do with two quick things. One is corporate governance. Companies in the past, some of the giants, had been very shareholder unfriendly. Acquisitions that had very little economic return profile. They weren't issuing dividends. There was no buybacks. Fast forward to today, acquisitions are being disposed of. That capital is being returned to shareholders. We're seeing increased buybacks. We're seeing dividends instituted increased. It's a big change. And in addition, we're seeing significant policy action trying to be supportive of reform. And I think that's constructive.
George, it's great to have you here in Hong Kong. George Maris there, CIO and Global Head of Equities at Principal Asset Management. Still ahead, we're going to talk about 10 reasons to buy Chinese stocks. That's according to Kinder Lau's next call here on what to do next and what's really going to trigger this second leg of this rally. Kinder Lau from Goldman Sachs, Chief China Equity Strategist, joins us at the bottom of this hour. We're also counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. New home prices data set to also be unveiled in just a few minutes' time. Break you those numbers pretty soon. This is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Welcome back. You're watching The China Show. About 20 minutes into the session in Taipei. So TSMC, of course, overnight, in case you missed it, up 10% in Taipei. I think we were up 6. Last we checked, decent. I think that's an understatement. Set of earnings here for the tech giant here. Strong set of numbers. Let's get more with Bell, up 5% now in Sydney. For us, Bell, what stood out to you the most here among the many things we could be tracking here on TSMC?
Yeah, I think you can sort of focus in on two areas in particular. The first is what they gave in terms of guidance, and this was something to watch really closely, and they lifted that for 2024 yet again. They did that just a few months ago. And also the CEO said in the call that even the next 5 years is looking strong for the business. So strong set of guidance. As we said, you can see some of those estimates there, or what we saw in terms of coming out from the company. The other point to track is what came through in the margins. And this was very strong as well, and something to keep an eye on very closely, because we saw it coming in around the 58% mark. That was the consensus, had been around 54.8, and also they lifted that into year end. And so when you have those higher margins, it could be a signal to us that TSMC is making more money out of its most expensive products, and that points to the demand for AI chips in particular. And this is where TSMC has such a strong lead in the market. So they're really sort of some of the very much the key takeaways from the numbers.
Yeah, well, what CC Wei mentioned there, the CEO, the demand is real. I believe it's just the beginning, really echoing what we heard from Jensen Huang just a few weeks ago. We're also hearing, though, about these reports the U.S. is looking into TSMC's dealings with Huawei. What's that about, Bill?
Yeah, so this is a report that's just come out from the information in the last half hour or so. And what we're hearing, or what they're reporting, is that the US Commerce Department is investigating whether TSMC has been making AI or smartphone chips for Huawei in China. Of course, this would contravene the sanctions that are already in place and the US rules. Sources are saying that the department is looking into the possibility that Huawei chips, or Huawei could be buying chips from TSMC using a network of intermediaries. And that is also really interesting because it sort of feeds into a report that we had at Bloomberg early this week that US lawmakers are pushing the Biden administration to block Huawei's suppliers from using American chip-making gear. So there is that sort of sense perhaps that Huawei is managing to build its chip plant network almost perhaps in secret, but certainly finding ways perhaps to get around US restrictions. So certainly a real flashpoint between the US and China, and something that's going to extend given the sort of tech rivalry we're seeing.
Belle, thank you. With that wrap up there, Annabelle Jewelers with the latest when it comes to those TSMC earnings as well. Seems like the market's still pretty uplifted by those numbers so far. You take a look at how the pre-market and everything is shaping up for this open and Hang Seng, and there you go. We're still well above that 20,000 level, which could be a key sort of milestone here, whether we bounce off on some of the weakness that we've seen of late. But certainly it's a key thing to watch after the CSI 300 finally did enter that correction yesterday. But does the data matter this time around? We'll get a preview of what to expect. Yields are ticking lower in the CGB market. We're at 209 levels now for your 10-year and 713.31 for the currency. And certainly a bit of weakness there on the back of this renewed dollar strength. Plenty more ahead. This is Bloomberg.
Welcome back. Happy Friday. Well, the gains have disappeared, something that has not and has remained a key feature of this equity market, greater Chinese equity market over the last, going on 3-4 weeks now, is vol. 10-day vol on the CSI 300 continues to climb. I mean, we're down a few points, but all that being said, we're at 80, which is the last time we saw this was back during the 2015 boom and bust cycle. So how do you trade it? We'll find out with Goldman Sachs, who will be joining us in a couple of minutes.
Yep. Kinder Lau, he's got 10 reasons why you should continue to buy Chinese stocks. Meanwhile, you have the likes of Laura Wang from Morgan Stanley saying limited re-rating potential when it comes to these Chinese stocks, unless we see more follow through in policies, which have since yesterday after that Ministry of Housing briefing has underwhelmed, right? So we're watching the property sector a little bit closely here. You're seeing, marginal gains in the pre-market in the Hang Seng, with HS Tech actually lower at the get-go. And we're watching very closely what goes on with the banks, especially here today, given that some of the major ones have cut those deposit rates, as was what reported by state media this week as well. Gold prices hitting a fresh record. That certainly is helping likes of Zijin Mining rise some 2%. And there you go, the property name still doing okay after what was a pretty brutal day yesterday. The strong negative reaction from that briefing. And you got to wonder, what were these traders actually expecting out of it? Really? We got the open coming up next. This is Bloomberg. Welcome back. You're watching the China Show. We're counting down the open of markets, and of course, a lot going on the next half hour or so. First, new home prices are set to drop any second now. Certainly, we'll see how weak this data was prior to this whole stimulus announcements from the PBOC and team. So certainly, we'll watch that very closely. And then we have, on top of that, at the top of the hour, September activity data to deal with too, Dave, next few minutes or so.
Yeah, which will maybe be a reminder why we're here and why all the stimulus measures and this policy pivots took place over the last month or so. Welcome back to the show. The final session of the week is a couple of seconds away. We're down 5 straight days now in MSCI China, so it's been challenging over the last few days, but we're still up, though, massively from the bottom. I think, where do we go from here now that the easy money's been made, now that we've reset from the reset? 0.2% to the downside, CSI 300. And it's just, fittingly so, we're going into earnings season as well, right? So I think we have a few names. CATL is coming out with earnings today. Zijin Mining's coming out as well. and what are corporates going to say about, what forward guidance will we hear from them? Is it too early to expect forward guidance to also see some sort of pivot? The Hong Kong Open today, let's have a look at that, please. 0.7% to the upside, 20,232 at the open on the Hang Seng Index. A couple of it's worth pointing out as well, so in case you missed it, about 40 minutes back, we did get some major Chinese banks come out and cut their deposit rates, as expected, given the sort of some of the news reports earlier on in the morning. Speaking of earnings, CATL, Western Mining, Zijin Mining, and iFly Tech are set to report results later today, just to look at how some of these are trading. Of course, when it comes to Zijin and some of the other miners as well, spot gold did hit a record high just a couple of minutes back.
It just hit 2,700, Dave.
Oh.
So, yes, there you go. Another record-breaking rally here that we're seeing when it comes to gold. And against this backdrop of people trying to price out the possibility of Fed cuts, right, and a stronger dollar. So those two things may be taking a bit of a backseat to all the, I guess, the haven demand that we're seeing when it comes to gold. The Middle East tensions, for one, is certainly what we're watching out for here this morning as well. So there you go. Gold prices are doing that. We're still waiting for that data here this morning. Before we get to that, oh, there you go. I'm seeing it now. New home prices, month on month, falling 0.71%. So it is another month of contraction. It's slightly better than the previous month of 0.73% contractions, but still, it shows the same sort of story, Dave. A 16th straight month where we have seen new home prices fall.
Yeah, and it brings to mind all the news flow that we've heard from this joint briefing yesterday. I think the PBOC put out some of the key takeaways that they had from the meeting the previous day as well, and I think it was HSBC yesterday that joined us. They brought forward their assumptions on when the housing market bottoms by a year to the middle of next year. And I think their definition is a stabilization of new home prices, right? And it's, how do we define a turnaround in the market? And they say, we'll need to see a few months. I think he said 12 months that things remain stable. And certainly we're far from that at this point in time. Okay, let's, why don't we get more context on this ahead, of course, of the other set of numbers we'll be getting in about 28 minutes from now. Stephen Engel, of course, our Chief North Asia correspondent, is here with us. Steve, go ahead.
Look, we know the third quarter was bad for GDP. It's probably the nadir. And you talked about the easy money. The easy prediction probably is fourth quarter, this current fourth quarter, the numbers are probably going to look better on the back of that stimulus, right? All the indicators for August were down. Retail sales and industrial production. Retail sales have had 7 consecutive months of low single-digit gains. We've seen industrial production in August, the lowest since, I believe, March. So the numbers in August are basically a harbinger to what we're likely to see in GDP coming out later this morning of the consensus estimates for 4.5% GDP growth. The consumer, a lot of scar tissue still there, especially with property and the like, and they're not spending. Retail sales expecting another low single digit for September, about 2.5%, 2.5%, following 2.1%. So it's an uptick, but there's a wide range of opinions. Bloomberg Economics thinks it's going to be 1.7%. So very, very slow growth in retail sales. So again, why I say fourth quarter is going to look good, even though we're not getting all that fiscal numbers for stimulus. Well, Xi Jinping came out this week and said, hey, provinces, hey, government officials, make every effort possible to deliver that full year growth of around 5%.
I mean, it goes to show what we've heard so far in terms of stimulus has been wearing off in some ways, right? If you see what this data suggests, right? Before, of course, this big blitz. What's expected from authorities next? I mean, we've had, 5 briefings already?
Right. And they're like, do we say a number? Do we not say a number? Do we reveal our cards right now? I think they're holding back right now. They're waiting for a number of things. They're waiting for the National People's Congress Standing Committee meeting, which is going to be held behind closed doors in Beijing either later this month or early November. They have to sign off essentially on any extra special budget or any revision to bond quotas and the like. I think they're also waiting for the U.S. election results to kind of see where the priorities need to be. If tariffs across the board of 60% plus are going to be hitting exporters, there might be different priorities. I think we're in a holding pattern right now as far as stimulus for fiscal side, which the market really wants. Let's bring up this full screen quote from Robin Shing of Morgan Stanley. He kind of sums it up this way, a two-pager. He says, large-scale consumption-focused package aimed at driving decisive reflation is unlikely. Yes, Beijing is progressing on its debt restructuring and rekindling confidence. But again, this restoring consumer confidence is going to be slow and bumpy, essentially what he says. Keep in mind, deflation has persisted now at the factory gate for 24 consecutive months, 2 straight years. That doesn't turn around in a V-shaped recovery.
Stephen Ingles, thank you so much, our Chief North Asia correspondent. On Steve's point there, one of the 10 reasons to buy Chinese equity markets from Goldman Sachs is that a lesson learned from Japan is a powerful and tradable rallies can exist even a prolonged deflationary bear market. If not now, when? With a 10. Kinger Lau is here with us, Chief China Equity Strategist at Goldman Sachs. How do I trade this market now?
Well, I think Stephen has summarized all the sort of mark-to-market situation pretty well. So I think the view that we have is that I think the jury is still out whether this is a sustainable bull market or just a short-term trading sort of type of situation. But what we are trying to argue here is that the policy put has clearly been triggered or exercised. We can debate about the strike price of the put, but clearly is in place. On top of that, when you look at valuations, the starting point was really depressed or suppressed. So in mid-September, we were at about 8.5 times forward earnings for MSCI China, went up to 11, now back down to 10. So I think at 10, this is still below what we think is the fair valuation levels for the Chinese equity market, even without factoring in additional stimulus that many investors have been hoping for or waiting more clarity for. And then earnings, very importantly, lots of attention on earnings right now. We recently raised our earnings expectations for this year from 8% to 12% for MSCI China. And the reason for that, obviously, number one, is the more proactive, more expansionary fiscal policy, particularly in the fourth quarter. But more importantly, I think, is next year, right? Given all the policy announcements that we have received, we think that GDP growth should have a meaningful sort of uplift. So we raised our number from 4.3 to 4.7 just a few days ago.
Your peers at Morgan Stanley are a little bit more cautious, right? They're saying that, they don't see additional re-rating in China unless we see more meaningful policy pivot emerging. And so they're thinking volatility might be here to stay, but we're going to stay in a range for some time. Because we continue to see this mismatch between what the market wants and what policymakers are actually announcing. So until we see that gap narrow, I mean, our stocks are just going to continue to fall from here.
Well, I think, Yvonne, I think in some way we are all subject to some sort of recency bias, right? So again, if you take a step back, we're up still 20% from the lows just from 4 weeks ago. Going back to my point about the policy put, I think the theme that we have been emphasizing is that the policy put is not to really maximize the upside, but to really take out the left tail in the system, right? Just by reducing your left tail in your valuations, I think you should argue for some re-rating. We can debate about the magnitude of the re-rating, but again, from 8.5 back to 10 times, I think this is pretty reasonable.
And to your point, we might see that in earnings, right? So you bumped up to 14% for this year, where do you see the bulk of those revisions coming from in the fourth quarter? Which sectors will be leading those revisions?
It's quite interesting. So last time I came here, we talked about the earnings for tech. Internet companies. I think if you look at the earnings revision trend, it's still very positive. So the large companies, Tencent, Baba, they're still receiving upward earnings revisions. But very recently, we are starting to see that broadening out to the financial sector, banks, brokers, insurance, given the very strong, given the strong performance in the equity market. So I think all the eyes will be on the consumer sector going forward, whether this round of policy easings will translate into fundamentals improvements in the consumer-related areas.
How do I look at the next catalyst to watch? I mean, obviously, we're looking for any more signs of any sort of more firepower from policymakers, but we're getting to an election in the U.S. Is that just noise to you at this point, Kinger? And is China policy still going to be the key driver of where markets go from here?
So I was in the U.S. Seeing a lot of investors last week. So particularly when we talk with fundamental focused investors, long-only investors, depends on which mandates, right? For emerging markets, Asia-Pacific mandates where China is a significant part of your benchmark, I think investors are a little bit more constructive and in terms of raising their exposures to Chinese equities after the recent recovery. But to your point, I think a lot of the global mandates that we met with, they still cite U.S. election as a near-term hurdle for them to re-engage China despite the potential improvement in fundamentals. So definitely is a risk that people are very focused on.
How much, I mean, to your point on global investors, based on your data and your whatever you guys used to track, how close are we to neutral as far as positioning is concerned?
Well, we have the numbers sort of updated as of end of September, which might not be the most updated ones. Yeah. But back then, based on our numbers or tracking, investors globally, they were still underweight China by above 300 basis points.
Okay.
So assuming all the mandates, EM, Asia-Pacific, global, they all go back to neutral, we estimate around $50 billion of potential buying flows to Chinese equities.
Okay, let's get to the last question, how to play this now. You just lifted H shares to overweight, but you still switch your tactical preference from H to A. What's the thinking behind that?
So we like both.
Yeah.
So we're expecting about 20% upside from here on a 12-month basis. But on a more tactical 3-month horizon, we think A looks a little bit better, given the direct policy support extended by the PBOC. But also importantly, the potential for retail investors to be more engaged this time around. So I think if you look at the past sort of rallies, like the reopening rallies and as well as the recovery in April and May, domestic retail investors, they were absent in those rallies. But this time around, I think the potential for them to be more active is pretty significant.
Yeah, they rushed back in during the Golden Week, right?
And then got burned, though.
And then got burned.
Yeah.
But I guess one of the things actually that stood out, and I forgot which of our guests it was that mentioned, at least we can make the assumption that liquidity is back in the market. So we can debate re-rating and price rallies, but do you think that liquidity is finally back? Like price discovery is now finally back to relatively normal levels right now? Well,
interest is definitely back. Okay. Regarding investing in Chinese equities. But again, when you think about turnover in the Asian market as well as in Hong Kong, definitely has re-rated a lot. But again, this time around, we think that there's still significant potential for households to deploy more capital in the equity market, especially given the headwinds that we all know about the property market.
All right, Kinger. Thank you. Kinger Lau, Chief China Equity Strategist at Goldman Sachs, joining us here in our Hong Kong studios. And coming up, the U.S. urges Israel to find a pathway to end the war in Gaza after the killing of Hamas leader Yahya Sinwar. We look at the implications of his death next. This is Bloomberg.
I'm standing before you today to inform you that Hamas leader Yahya Sinwar has been eliminated. The person who committed the most terrible massacre in the history of our nation since the Holocaust, the mass murderer who murdered thousands of Israelis and kidnapped hundreds of our citizens, was eliminated today by our heroic soldiers. And today, as we promised to do, we settled the account with him. Today, evil has suffered a heavy blow, but the task before us is not yet complete.
And that was Israeli Prime Minister Benjamin Netanyahu there. The U.S. also seeing Sinwar's death as a pathway to end the war in Gaza. President Biden says, quote, now is a time to move on and move towards a ceasefire and bring the hostages home. Let's bring in our senior editor, Bill Ferry, joining us from Singapore with the latest here. It seems like the U.S. sees this opportunity as a way to maybe end this war. Bill, it doesn't seem like Benjamin Netanyahu feels that way. He wants to kind of continue to fight and vowing to fight further.
Right. I think both sides would say that this is probably a game-changing moment, a major turn of events in this conflict that started over a year ago now. The U.S., as you said there, hoping it will become an opportunity for Israel to perhaps agree to some kind of a truce, Israel and Hamas, frankly. And not just the U.S. We heard French President Emmanuel Macron saying something similar. But for Netanyahu, obviously a huge moment. It's hard to imagine this conflict having wound down without them capturing or killing Yahya Sinwar. But they are still talking very much about the hostages that are still held, about 100 hostages believed to still be held by Hamas. They want to see those hostages released before there's really any talk about a longer-term truce in this conflict.
Bill, what about since October 7th last year, it's several different fronts have opened up in this conflict, including Iran, and that's where I'm going with this next question. Do you think what's happened here changes the Israel-Iran dynamic there, and this retaliation that we are expecting at some point from Israel that they've said they're going to do?
Maybe on the margins it could change how Netanyahu and his government think about the scale of the retaliation. They've promised to retaliate for that salvo of missiles and drones that Iran launched at them now more than a week ago. I would expect them to follow through with that. But when you're talking about the broader conflict, if there is a way to bring even a temporary truce to this conflict between Israel and Hamas, that could very well be something that changes the intensity of the conflict with Hezbollah in Lebanon and even with the Houthis in Yemen. They were always ostensibly fighting because of the conflict in Gaza. So if that calms down in the coming days or coming weeks, there is a chance that you'd see those other fronts calm down. But in terms of Iran, I would expect Israel to still retaliate. It's just really maybe a question of the scale of that retaliation at this point.
Bill, thank you. Bill Ferry's there in Singapore for us, getting us up to speed, and possibly, of course, how this changes the calculations around that potential retaliation directed at Iran. Right. Equity markets across the region, looking at my screens right now. So greater Chinese markets are actually up, particularly in Hong Kong. We're flat on the CSI 300. The big news, though, is market-wise in the last hour has been spot gold. 40 minutes back hit a record, and a couple of minutes back, as you can see on your screens, took out the 2,700 level announced, 0.5% to the upside here. Plenty more ahead. This is Bloomberg. Welcome back. So we're 21 minutes into the session here. So 21 minutes from the housing price numbers, the latest ones, which really underscore, not unsurprisingly so, still a period of home price declines in China. We'll show you a chart of that in a moment here. And in a couple of minutes, of course, we'll be getting some of the other economic numbers for the third quarter. GDP growth is coming out, plus the other activity numbers coming through as well. And it's really a reminder of how quickly investors can miscalculate the pace of returns, right? And we're up substantially, but we're now almost down, if you take a step back, almost 50% from the top just, a week and a half ago.
Yeah, HSCEI certainly is one that's given up nearly half of its gains already. And you take a look at what some of these ETFs have done, they're actually now among the biggest losers in U.S. markets and join the ranks of funds managed by Cathie Wood. So, certainly it's a staple, which is volatility now, but we're certainly seeing a lot of movement when it comes to these ETFs and how quickly sentiment is actually changing day by day, really.
Yeah, it really underscores, I think part of the story was, the Chinese markets remain, to many investors, a trader's market more than an investment vehicle. Mm-hmm. So it underscores really if you got in on time, if you were in the market before the policy pivot, you've done fantastically well. If you took a point in time alongside that massive rally, you're probably not as good well off as some of the charts actually suggest. In fact, we do have the peak to trough. Can we show that, guys, before we get to some of the estimates for the activity numbers coming through? Because it really underscores, in many ways, a reset from the reset that's actually taking place. And I think we showed you a PE graphic up earlier on. You know, I think Kindra Lau mentioned early on, we went from 8.5 times earnings to 11, and we're back to 10. So now the jury's out how long the re-rating will be from the current levels. And I think Laura Wang and Morgan Stanley, she has a different view from the guys at Goldman.
Yeah, they said you're not going to see any sort of significant re-rating unless we see more details on policy follow-through, the scale of which numbers to some of the details that we've heard so far here. So there's a bit of a, I guess, skepticism there still from Morgan Stanley about how much more we can actually see. They're thinking, look, we could just stay range-bound, but volatility could stay pretty elevated the next few weeks or so. Kindra Lau seems to think, no, you know, now that we've gone from 8 to 10 valuations, it's really a matter of the degree of that re-rating, which we can debate about. But right now, he says 8 to 10, pretty reasonable. Yeah,
the policy put is there. In fact, so in a couple of minutes, ANZ is joining us right now, and as I was scrambling for the notes here of Raymond Young, because I think what's key here as well is if the scale of the injection is insufficient, this is on the housing market as well, the authorities will likely top it up again. I think that is a key message here, that perhaps the reason why we do not have a big number to latch on to as far as how large the stimulus is because that big number is a fluid concept depending on the situation of the economy, right? And the housing market, which data came out earlier on, is a proof that it will take time to turn the ship around.
Yeah, 4.5% for the third quarter is what people are expecting for this GDP print. That's going to happen in just a few minutes' time. As we mentioned, that is the weakest pace in 6 quarters. So that's one to watch here. Retail sales maybe getting a slight bump here, but still looking pretty weak, historically speaking. So we'll break down all that data in just a few moments here. You're watching the China Show. Keep it here. Welcome back to the China Show. Here's a look at the CSI 300 just a half hour into the session, and we are seeing a bit more volatility here as we count down to this activity data that's set to come through in just a few seconds now. So we're slightly lower on CSI 300, but certainly we're watching very closely after the 5th press briefing that we saw yesterday here, where property and what we heard from the Minister of Housing was a bit underwhelming there, but it seems like at least what we saw in the HSI, some of these names were recovering after what was a pretty brutal sell-off yesterday. But then again, keep in mind this data, pretty dated, right? This is all pre-stimulus announcement, right? So take it with a grain of salt. Have you, Dave?
Nice to know.
Nice to know. Maybe know why now.
Yeah, now we know why.
Yeah.
The data that's going to come out is likely going to be very, very soft. In fact, here we go. The data is all just crossing our Bloomberg terminals. Okay, so we have growth numbers coming through, activity numbers coming. Let me start off with, I guess, the headline number on GDP growth. The estimate 4.5%, and we're looking at 4.6% year-on-year for the third quarter. As far as industrial output goes, this is for September, 5.4%. That is a substantial beat and substantially above estimates of 4.6%. What other things are you seeing, Yvonne?
Yeah, so I guess retail sales was a pretty sizable beat, at least, of 3.2%. The consensus was for 2.5%. But still, I mean, those are still pretty weak numbers. But yes, the GDP numbers also beat to the upside in some ways. But then again, you take a look at residential property sales, for example, that's just coming through. That's down some 24%. You take a look at the property investment side of things, that's still down more than 10%. So the picture really hasn't quite changed. The key question is, does the market care about this, right? Do we just kind of rule it out and just focus on what we've heard so far into the stimulus measures? And do we rule out, do we need to start caring more about the numbers for next year and growth forecast for 2025?
Because it's reasonably safe to assume that we'll be at the growth target for the year, and it's really what next year looks like, right?
Yeah.
And whether inflation comes back next year is the other key question there as well. Let's put that question to Raymond Young, here with us on set, Chief Greater China Economist at ANZ. Let's start with Yvonne's point there. Apart from the use of these numbers in economic models, resetting projections, why do I need to care about these numbers? What utility does this bring our lives, Raymond Young?
Well, I think it's just a backdrop to support or to explain why the top management is very eager to boost the economy. They listen to the boss that I really have to achieve the target 2024, the economic and social target, and widely expect to be able to achieve 5% growth with this stimulus. But the question is whether these type of measures so far, we call them stimulus, but some of the measures basically is a structural recipe to address some of the long-term problem. Would that be really useful to boost or to sustain the growth momentum starting from this quarter and the following quarters all the way to 2005 or even 2006? We're looking at 4.3% growth next year, 2025. This year, we keep it at 4.9, so we're still seeing a slowdown of the overall economy. But the question is, are we seeing the demands to come back, both the domestic demand and external demand? And my worry is that the external environment will deteriorate because of the new U.S. government, maybe trade tension. At the same time, whether the measures as they provide yesterday by the housing minister will really revive the domestic demand for properties, because that's where the household wealth or household accumulated wealth, so that they will be more encouraged and have more confidence to spend. Now, the retail sales number is not bad, more than 3%, I think is a starting point. With the national holiday in October, maybe over the next few months we'll see a gradual improvement in retail sales, but what we care is whether that will be, persist over the next few months all the way to the Chinese New Year next year.
So you're saying a lot of it is very supply-driven, what we've seen in the stimulus so far. What are you still looking out for now, given the policy announcements already announced? Is it still a number that we need for fiscal stimulus? Is it the scale? Is it, what is still missing?
Yeah, what haven't we heard?
Yeah.
I think what we need is for all the policy to come together as a package. And also, the central government has a lot of policy. All they can do is to ease the monetary policy at the central bank's level, to set the rule and who can use the fund. The stock market can tap the central bank's funding. At the same time, to avoid a Japan style, last decade, you really need to be having a very aggressive fiscal policy. And so far, of course, that everybody is still waiting for the National People's Congress Standing Committee, the NPC, approval for maybe a supplementary budget, front-loading some of the government bonds to be issued, and perhaps a new fiscal deficit at the official general account. So these are still some more to come. But what we really need is that whether the local governments now have to listen to the central government mandate and execute the plan. Yeah. And so yesterday, I see that that's not bad. If they talk about they have already deployed the white list of 2.23 trillion already deployed. I think it's a pretty good progress in terms of how they trying to address the problem in the property residential construction sectors.
Does it do anything to change at least the supply and demand dynamics, though, in this property market?
So far, of course, it's more the supply side, but then to revive the demand, we definitely need to have the property markets to come back, because that's where people, link their current, household balance sheets to, so 60% of the household balance sheets is basically property.
Right. You opened up a lot of doors there. How big of a game changer is it unlocking the fiscal room for local governments to spend on whatever they see fit to boost their growth in their jurisdictions?
I think that will be a double-digit number. Increasingly, even a lot of analysts and economists I spoke with onshore, in China, agree that if you still stick to a very disciplined, prudent fiscal policy, is not going to help to address balance sheet recession. You definitely need to have a very aggressive fiscal policy. Of course, by the book, that will officially still be 3% of fiscal balances, but because those bonds raised at the local government level, or even the special treasury bond or central banks funding, they are not counted as a fiscal policy, the balance. So, but the actual, injection from the fiscal side, not only by the central bank or PBOC, will accommodate the expansion of the budget. That would be probably close to 10 trillion, next year or the next few years. We're looking at 6 trillion every year adding 2 trillion more in the bonds issue at the local government level and the central government level.
Okay. Can they find ways to spend this money more productively, though? I mean, what's the best recipe, you think?
People talk about the cash handout, to give the money to the household, but I don't think that will be a long-term solution. Perhaps it's more importantly is to support a property recovery. I think there is no other way. That's universally the only way to boost domestic demand is through reviving property price. And right now, they have relaxed all the constraints and lowered the mortgage rate. But a larger degree of mortgage rate cut is required so that I won't have incentive to put my money to buy government bond at 2% return versus the property rental yield is just 1.5% in Beijing, Guangzhou, in the top tier cities.
Yeah.
So these are all we needed to lower the mortgage rate more. Yesterday, they talked about the mortgage rate cut, but I think that there will still be more room to have a larger mortgage rate cut to let the market achieve the equilibrium.
As we were going through the last 3 weeks, I was looking at the equity market, which went up 30-40%, but the bond yields only 2 days went up, and then since then have started to grind back down. And I think in my mind, I use that as an indicator of whether the market thinks this will have some inflationary impact moving forward. Where do you think the next 50 basis point move will be on the 10-year bond? Do you think we get to 2.5% or do we get to 1.7% first?
I would see it 1.7%. Of course, the central bank doesn't like to see the bond yield to be too low. They will continue to intervene in the market. The PBOC can trade and sell bond, in the market. Of course, what the central bank really need to address the property market is to buy bond rather than selling bond, right? So if the same property crisis happened in Japan, happened in the U.S., then you see central banks start to expand the balance sheets at the last resort, and they are the best, buyer for and expand the fiscal budget. I think that's the right direction to go. It's not to sell bond, but to let the bond yield to come down. I think that's the way to address the cyclical downturn of China.
And what's I guess my other question is, what is the best case scenario when you consider the multiplier effect? If they are able to, so let's not talk about 3% budget deficit, because effectively it's much more than that, to your point, right? 6 to 10 trillion. Assuming they manage to do that, assuming they find productive ways and efficient ways to speed up spending, the multiplier effect, do we get to a point where inflation comes back in at least a decent way?
Credit impulse.
The credit impulse.
Yeah.
There we go.
Yeah. So far, the credit impulse is not very effective. The more money you print, the more chances for you fall into a liquidity trap because the demand is not coming back. So what you need is to revive the confidence first, to boost the property price, and for the government to not to talk about housing for living again for a while, so that people start to think that, well, it's still a good way to store or to put the money as a long-term investment. That's the way to see. Even though I doubt that they have abandoned the policy, I think they still keep this policy, but at least you don't talk about it for a few years. That would be very helpful.
All right, Raymond, you're staying with us. Raymond Yuen there from ANZ. We are continuing to watch these lines from the National Bureau of Statistics is holding a news conference here right now. They were talking not too much so far in terms of headlines here, so we'll continue to watch what goes on. But certainly you're seeing not too much movement in the data or on the markets here on this data. The offshore rent did actually continue to see some losses here. Aussie dollar seems to be holding these gains after this data. So the market's willing to shrug this one off, I think, Dave. Yeah, until we get, I guess, more forward-looking policy pronouncements here out of Chinese officials. We'll get you more, of course, on the market rundown, the market reaction, and perhaps more context out of the National Bureau of Statistics. And they just released, of course, GDP numbers for the third quarter and also activity numbers for the month of September. Tia Livigo on your Bloomberg terminals. Take us through more on this, more context and commentary, of course, from our team here at Bloomberg.
season is here.
I think that this earnings season is going to be so important.
Bloomberg is first to break the numbers.
NVIDIA earnings now crossing the wire.
Bank of America, the retailer Five Below.
There is something for everybody.
With the smartest insights.
Weaker inflation is not great for earnings.
I think the consumer's a bit more resilient.
You've had earnings recessions flow through growth and then cyclicals and defensives.
Earnings cycle continues on Wall Street.
Continuing coverage on Bloomberg. Context changes everything.
Right, welcome back. About 14 minutes since the National Bureau of Statistics released these economic indicators out of China. The other big story as we wrap up this week is, while Chinese markets have sort of reset from the reset, there's a reset of expectations around the Fed, right? Is a pause properly on the table? The ECB really gave us something to talk about yesterday, cut for the third time, and then you have a 50% probability as I speak of a 50 basis point cut out of the ECB in December. So rates are coming down in lots of places around the world. To wrap up all the macro news this week, Garfield Reynolds, who leads our MLive team for the Asia Pacific, joining us right now. Garfield, just take us through the Fed conversation right now, and not to mention, of course, the added potency out of the ECB overnight.
Yeah, well, I mean, the Fed just keeps on being driven towards the idea that, maybe that 50 basis points in September was 25 basis points too far. The data since then have been mostly, very good. And the Atlanta Fed has a GDP now, like a nowcast that runs a rule over the incoming data and says, okay, what can we expect from the current quarter's GDP? And that's now at 3.4% and has been climbing and climbing, with the latest data overnight being the retail sales going up more strongly than expected and jobless claims surprising by coming down. So the case might not be there for a pause next month or in December just yet, but it's certainly on the table. And that's, that's disconcerting the bond market, which faces some other concerns with potential increased issuance next year once the election is out of the way. So that's the picture for the Fed. Not so low for quite some time could well be the case. And then across the Atlantic, completely different set of circumstances where the EU is showing serious signs of difficulties with the economies there, especially Germany, and they're not having the capacity to slow down their rate cuts. Instead, as you were mentioning, that's probably pretty reasonable. We've got a 50 basis point cut on the table for the EU, so you've got the euro heading down. We've had the yen flirting, with those lows that came around the time when intervention occurred to strengthen it. And the US dollar just keeps marching higher.
Garfield, thank you. Garfield, who leads our Bloomberg Markets Asia coverage, joining us out of Sydney here this morning. We're back with Raymond Young, Chief Greater China Economist at ANZ. We talked about a lot of the domestic sort of dynamics. The external picture, though, as Garfield highlighted, is now the narrative seems to suggest that the Fed may not be able to cut as vigorously as what markets have been pricing in some ways. How does that change the equation for the PBOC, for example, which used to look at the Fed policy as a bit of a constraint? We saw the 50 basis point cut unleashed a lot of opportunity and the door open, but now we're talking maybe that's narrowing. Do we have to start worrying about the currency again?
No, obviously, it's the PBOC was willing to cut in September, a few days after the Fed cut. Let's speak about the policy function of the PBOC is willing to open the door as long as you don't hurt the exchange rate, and the renminbi exchange rate down to 7 at one point is now softened a bit because of the changing or repricing of the Fed cut over the next few months. Strong job markets number and also and so forth. If they see this is still a tactical hold maybe over the next 1 or 2 months, but the entire easing cycle is still the basic assumption of the Chinese policymakers. So I do believe that the PBOC just talk about 10 basis points, 20 basis points, that's very incremental cut. Doesn't really to be affected by by the Fed and other central banks.
The prospect of tariffs, and speaking of the U.S., right, how does that affect, I mean, not just the Fed, how does it affect policymakers in China that are looking to backstop the economy, not knowing if they have to take an additional insurance policy in case tariffs go up?
Yeah, what we've seen is the overcapacity in China is still the big issue, even with the tariff. But the Chinese products are so price competitive, right, so that they're able to drive the price down even with fixing the exchange rate, but then they're able to sell an EV at such a low price. And that's caused that trigger some of the tariff measures, not only on the U.S. side, but also in EU, that they're going to make a decision on the 4th of November. I think this is all under the radar of Beijing, but how they link the trade policy with the domestic slowdown, I think we probably see some disconnection between the two over the next maybe 12 months, because now it's not really the external demand leading to the slowdown of the economy, but more the poverty slowdown resulting in a slow growth momentum in domestic demand.
What's the outlook for exports then for next year?
I do see there's still a positive growth because, if you look at the Chinese export, is more about the electronics. And AI remain the main theme for a lot of investment around the world, that they do need electronics products. But of course, that I think is a structural change and a shift of the direct trade between China and the U.S., but more a realignment of trade routing through Mexico or Southeast Asia. That's still regarded as China trade, and the trade share between China and ASEAN will be larger to offset some of the direct realignment or supply chain shift between China and the U.S.
Do you think that remains a dependable pillar of growth, not just in the next quarter, but over the next, let's say, 2-3 years from now?
This year, export's been a main driver to offset some of the major or massive slowdown of domestic demand. But next year, I believe there will still, the trade risk will be heightened, and that would require a larger support for domestic economy to offset some of the weakness in the external demand.
How are you looking at the commentary we've heard from these presidential candidates in the U.S., right? Trump basically saying tariff is his favorite word. How much weight should we put into those comments in some ways, where when you hear the likes of Janet Yellen is also kind of clapping back on those comments too and saying tariffs are not quite good for the economy? I mean, how seriously should we be looking at the whole tariff impact?
Very interesting that you look at Janet Yellen's comments more pro-business from the Democrat side than the Republican. But I think it's the difference between the two is the approach of how they handle China trade, but the direction is the same, that they really want to, I'm not using the term decoupling between the two, but at least to keep a distance from China and not to over-relying on Chinese production facilities. But at the same time, they do see, I believe that American businesses are still seeing that the Chinese domestic market is a big market. The consumer market and some of the sector are still very favorable to U.S. business. And I just came back from Shanghai and spoke to a lot of American companies, and they do see, the Chinese market is a big market for them in the longer term. So I think that there's got to be having some compromise. But the two candidates will use a different approach when they are dealing with China.
Well, speaking of your trip, give us some insights. What did you? How are things? How are things on the ground? And the reason I bring it up, can we show the retail sales number, please, which came out? Something stuck with me when you said, at 3+%, that was a big beat. The fact that we're talking about 3+% is a big beat. I mean, gone were the days where it's 8% was a disappointing number. What's the new normal? How does a new normal feel on the ground?
I think that if we are seeing 5% by the end of the year, I will clap my hand. I think this, if it's come back to 4%, it's already a big achievement by the end of the year. Now, of course, we're not talking about the or shrinking in consumption volume is because of the price. And in China, we all talk about consumption downgrade. Rather than spending on a very expensive item or 50 RMB for a cup of coffee, I'd rather go to 7 yuan for a bubble tea. That's what I would do. What I'm seeing that people are doing. You're lining up a good restaurant rather than everywhere. They do eat and drink, but they become more selective and cautious in terms of spending.
Raymond, it was great to speak with you. Let's do this again soon. Raymond Young, their chief Greater China economist at ANZ. Now, the National Bureau of Statistics, of course, in China is holding this press briefing right now. On your left, market, or the lack of market reaction. On your right, dollar China, 713.28 against the U.S. dollar. TLI Vigo takes you through our ongoing blog on everything that's been said, released so far out of Beijing. Plenty more ahead. This is Bloomberg. Welcome back. Here are some of the stories we're following right now. So Bloomberg has been told that Nokia has cut almost 2,000 jobs in China. Now, sources say the move is part of a sweeping cost-cutting or cost-reduction program as the Finnish company grapples with a sluggish telcos equipment market. Now, that's also said to be in line with a broad effort to reduce headcount by as much as 14,000. Now, Hyundai's record India IPO has been oversubscribed by more than 2 times, with strong institutional demand making up for a tepid retail take-up. The offering will raise $3.3 billion at the upper end of the range, and the Indian unit is valued at about $19 billion, and shares are set to start trading on October 27th.
Watching chip stocks very closely, TSMC, that rally continues there. Shenzhen Megmeet, they're talking about this cooperation with NVIDIA. We're up, limit up. This is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Welcome back. You're watching The China Show. Happy Friday morning, by the way, from the Asia Pacific. The National Bureau of Statistics in China is currently holding their live press briefing after they released activity numbers for September, third quarter GDP numbers as well. Separately, Thailand and some of these lines are just crossing our Bloomberg terminals, talking about the PBOC. So let me just go through some of the details here. The PBOC will be issuing a document on relending today, that they're reiterating that we could see, and this is expected by markets, a further lowering of the RRR by year end. Those are comments, according to Thailand, from PBOC Governor Pan Gongshun speaking at a Financial Street forum taking place. It doesn't seem like their officials are done giving us bits and pieces, of course, of where details on this major policy pivot. In case you missed it I would say about 2 hours back, major Chinese banks did cut their deposit rates. So we'll see. But apart from that, so far, nothing big yet coming through out of the numbers. A wise man once said, if your dreams aren't big enough, if you're not scared of your dreams, something like that. What was it? If your dreams aren't big enough, you're not dreaming big enough. If they don't scare you, they're not big enough. And I think as far as markets go, we'll need to see probably more. To Laura Wang's point out of Morgan Stanley, a further re-rating of this Chinese equity market will need a further push coming out of policymakers on this major policy
And
pivot.
it's not going to come from the PBOC. I think that we've heard everything that we've had to heard from Governor Pan, right? Yeah. I think it's still fiscal that is still the missing piece here. So I'm guessing it helps by the margin, some of these comments of at least where we're going to see this LPR expected to drop about 0.2 to a quarter percentage point on October 21st. They're very specific as well of when these cuts are going to come through. Or to also take a look at very closely some of these moves that we're seeing in the chip sector here as well, because thanks to TSMC, it seems like the narrative has shifted once again, that there is now more optimism around this AI demand picture here. So you're seeing that when it comes to the stock, we're up some 5%. The ADRs rocketed to a record high overnight as well. You're not quite seeing that to some of the other chip makers in Korea, for example. SK Hynix is still down close to 4% this morning. Let's get to our tech reporter, Annabelle Drewer. She's with us to break down those numbers. Belle, I mean, does this at least dispel those concerns out there that maybe the market may have misjudged what this AI demand picture is going to look like?
Yeah, we've heard repeatedly analysts sort of cautioning or pouring cold water over all of the optimism around AI, or saying it could at least taper off. At the same time, we've continued to hear from company executives in the tech space saying that AI's demand is strong, it's real, it's got a lot more to grow from here, and that was really what came through in this TSMC results. We knew the sales were going to be strong, so we were kind of focusing on different areas. Firstly, that guidance, you can see here it was lifted for the fourth quarter. We've already seen it being lifted throughout the course of 2024 and into the next year as well. It's looking solid. The company's CEO is saying that we could actually see strong growth for 5 years for TSMC. What else was the other thing to track was the margins, and this was something that came in strong. You can see that gross margin at 58%. It was a few percentage points above consensus. They also lifted it into the fourth quarter, and that really signals to us that TSMC is making money out of its highest revenue generating products, and that speaks to that demand around AI in particular, and TSMC just has such a strong lead in that market.
Yeah, well, speaking of, separately, we're also hearing reports that regulators are looking into TSMC's dealings with Huawei. What details do we know about that?
Yes, this is coming from the information, and what they're saying, according to their sources, is that the US Commerce Department is investigating whether TSMC has been making AI or semiconductor or smartphone chips for Huawei, and that would, of course, be a breach of US sanctions that are in place on that Chinese company, Huawei. The sources are saying that possibly the department is looking into whether Huawei managed to buy chips through its intermediaries, and it kind of adds to a Bloomberg story we had earlier this week talking about the sort of clandestine network that Huawei is building to achieve its semiconductor ambition. So certainly it does seem like there's a lot of pressure growing in Washington still on the company. We were also hearing from Bloomberg, or in our Bloomberg reporting earlier this week, that lawmakers are pushing the Biden administration to block Huawei suppliers from using American chip-making gear. So it seems very much bipartisan and not something that's going to go away post the vote in November.
We're looking at other earnings as well. CATL, Bell, the Chinese battery maker, due later. What's expected there?
Yeah, I mean, you talk about sort of TSMC being a linchpin. CATL is very much a linchpin in the EV supply chain. And the numbers we're expecting today actually could be their best quarter ever for the company. What is being put down to, or what that's being put down to, is firstly demand for its products. And that's supposed to be strong, or expected to be strong, particularly in China. It's helping offset sort of some of the weakness we're seeing in Europe and US, where sort of consumer apathy perhaps we're seeing toward EVs. It's still robust in China. Bloomberg intelligence team saying net income could have risen 20% sequentially to around 15 billion yuan in the third quarter. The other factor is that we've seen that real price war, not only in the EV space, but in the battery space for EVs, and that seems to have eased off somewhat. So again, that could alleviate some of the pressure on the company. But those CATL earnings are due later today.
Bell, thank you. And looking ahead to that, of course, Annabelle Jewellers, our tech reporter over in Sydney for us. Right, some breaking news here out of China, reporting out of Thailand. For one, you're looking at a continued meltdown in bond yields. So we're now at a 210 handle on the Chinese 10-year yield. On that, the PBOC is looking to it's aiming to curb government bond yields one-way drop and the risks of a one-way direction here as far as, I would imagine, lower yields are concerned. There seems to be other things happening in this market too right now, Yvonne.
Yeah, I mean, we're watching, equity markets are turning a little bit more favorable, I guess, looking a bit more positive, especially when it comes to Shenzhen. I think the Chinex is up some 1% or so. So Sheng also mentioning in this briefing that China has taken a series of stabilizing policies on housing. So once again, reiterating why we've heard some of these targeted policies in the last 24 hours or so. But then again, it's not really doing much to stop this rally right now across CGBs this morning. We're checking 7&I. That's one other stock we're watching out of Japan here. So a lot more, I guess, updates here when it comes to what Couche-Tard and where they're positioning when it comes to what comes next with this deal. So it looks like they want to buy the entire 7&I company here and keep the operations of the Japanese convenience store and retail channel intact. That's according to the chairman. That's despite, what we've heard from 7&I so far is getting a bit of a cold shoulder to Couche-Tard about meeting once again and discussing further. They've also been talking about this massive restructuring of splitting the company. Let's get the latest now from our senior editor, Reed Stevenson, joining us with the latest. Reed, it's a continued saga here. Just bring us up to date. What's the latest?
Indeed. I mean, it was just, about a week ago when we got that new indicated price from Couche-Tard of about 7 trillion yen, about $48 billion. And then we find out, the following week that Couche-Tard's founder, Alain Bouchard, as well as the management team are in Tokyo trying to meet with Seven & I management. And, this is quite a media-shy company, but they did sit down with us to kind of lay out their plan, make their case for acquiring Seven & I. And, one of the messages that they had was that, they're not looking to break up the company. They're not looking for part of the company. They want the entire enterprise. And, they have answers to any concerns over any such deal. And essentially, they weren't able to meet with, the CEO, Ryuichi Isaka, or the chairman as well. But essentially, the structure here is that, there is a special committee that is tasked with looking into this deal. And the head of the special committee, Steve Dacus, was actually not in Japan at the time. So that was another kind of missed opportunity, although they did tell me in the interview that they had met with him, probably over Zoom or in person somewhere else. And so, it's not a picture of sort of nothing happening, but clearly Seven & I is also reluctant to go forward with this. But at the moment, in the words of Couche-Tard executives, this is a compelling, hard to ignore number. And so it's going to be really interesting to see what we're going to see develop in the coming weeks and months.
Reed, thank you. Reed Stevenson, our senior editor in Tokyo for us, and the latest here on this deal that keeps giving, really, as far as news goes. More on the breaking news story coming through here out of the PBOC, and as you can see, the markets are reacting very favorably to the headlines coming through out of the central bank and these Thailand reports. In fact, our guys on the MLive team, Mark Cranfield, has headlined this, that the PBOC headlines are supporting Chinese stocks yet again. A lot of this will, for one, into bond markets. They're also talking about the size of what looked to be the loans to fund the share buybacks, the initial quota for companies to buy back their stock there.
So initial quota for that share buyback loan is 300 billion renminbi. So we have some more numbers on that. They're going to step up the counter-cyclical policy adjustment. Price rebound to be a key policy consideration here. So it's interesting that it's once again Pan Gongsheng that's moving this market after they've had that big press conference, the first one just a few weeks ago. I spoke too soon when I said it's all about fiscal, but it seems like he's giving a little bit more indication here of where this LPR and where it's going to go as well, that we are likely going to see a cut in just 3 days when those banks do announce that. So, yeah, there you go. Big turnaround this morning.
Yeah, we're up 2% now on this. So as our guest in the last hour pointing out, liquidity drives markets, and every time the PBOC talks about liquidity, this is almost exactly what happens each and every time. It's worth mentioning, too, and separately, there is a separate press briefing taking place as we speak in Beijing from the National Bureau of Statistics, which the markets, for now, are focused in on monetary officials more than the actual numbers themselves. Plenty more ahead. This is Bloomberg.
All right, checking oil prices as well as gold. You take a look at what we're seeing. So we're seeing a bit of a bid when it comes to oil markets here this morning on the back of what we heard with Israel killing the Hamas leader Sinwar there and vowing to press on this fight, despite what we've heard from the U.S., calling for maybe that this killing could be an opportunity for them, to Israel, to actually end the conflict there. So certainly there's a lot of confusion. We're watching very closely on this geopolitical risk. Gold prices on the back of these tensions that we're seeing in the Middle East also rising to a record. Spot gold that we're talking about, we briefly broke above that 2,700 level. There we go. We're at 2,710 this morning Israel says its soldiers have killed that Hamas leader, Yahya Sinwar. More on that now, who was the architect of those October 7 attacks that sparked the latest conflict in Gaza. Israel says Sinwar was killed earlier this week in what appeared to be a chance encounter. Sinwar's death leaves the Gaza-based militant group with no clear successor. In other global news, U.S. officials say Chinese and Russian companies are collaborating to produce long-range attack drones for use against Ukraine. The U.S. says China still isn't providing direct lethal support to Russia. However, NATO leaders have called China a, quote, decisive enabler of Russia's war. The U.S. has levied new sanctions against Chinese and Russian companies and one Russian individual for their alleged roles. And as the U.S. election draws closer, some analysts are kind of debating, right? We've asked this to a lot of analysts out there about what does China prefer when it comes to a U.S. president. Is it more about what we've heard from Kamala Harris? And how much of that could be a continuation of what we saw from the Biden administration and Trump, which is, of course, seen as more disruptive. We just heard this week with his conversation with Micklethwait that, he's doubling down on his vow for those 60% tariffs on China if he becomes president. Yeah, it will be his still, almost a rerun of his first term if he does win, of course, in the upcoming elections. He will be using tariffs, and that's my key. I watched the entire interview, by the way, just very recently again, as his main policy negotiation tool when it comes to the Chinese. And I think it's a good point that this Bloomberg story that highlights this preference for Harris. If you remember, the reset in relations did take place under Biden, right? Yeah. And somewhat you could make a reasonable argument that the momentum of building on that continues with Harris, which obviously she's seen as sort of more of the same. Yeah. Still hard in China, but more predictable. More predictable. As far as her stance goes. At least it could be something that we've seen before, right, with this administration of those talks with Wang Yi, Jake Sullivan, certainly did lay the groundwork for at least U.S.-China relations to stabilize, I guess you could say, in the last few months. But when you have someone as unpredictable as Trump, I think, that's where the uncertainty arises, right? What are the allies going to do? Everything in response to that. So certainly that seems to be where China is leaning towards now, is a Harris presidency. Yeah, Raymond Young, who joined us out of ANZ earlier on, really wanted to talk about the risks of these tariffs coming through, right? Yeah. And in his mind, it's one of the most underappreciated risks, because we know the threat of new tariffs has been around, and not just the EU and the US, of course, but he seems to think that the markets are underestimating the second and third order effects if we do get more tariffs out of China. And one of the things I think that's come up is that dollar China just shoots up another leg if we do see Donald Trump again to take the Oval Office. I think George Sutton from BNP Paribas said that the first place you're going to see it is in the FX markets. Yeah, straight up. After this election. Speaking of presidency, we're talking about Indonesia now. Prabowo Subianto will be sworn in this weekend as Indonesia's next president. The former defense minister says he's aiming for policy continuity as he replaces the popular Joko Widodo. But as Bloomberg's Haslinda Ahmed reports, Prabowo faces questions over his past as well as challenges ahead.
President Prabowo takes office with an ambitious program, including a target of 8% growth in the economy. Indonesia Maju, or Developing Indonesia, is the key strategy. And harnessing the country's natural resources lies at its heart, especially nickel. Vital to the production of EV batteries, Indonesia increasingly wants to control not just the mining of nickel, but its refining too.
I think this is kind of a leadership that we'll see under Prabowo, someone who understands the international political landscape, who understands how resources are mobilized so that he can gain advantage from that.
Still, managing Indonesia's natural resources could be a potential flashpoint for foreign relations. Prabowo has been critical of the EU's new deforestation law, blaming the destruction of forests for palm oil production on the legacy of colonization. Indonesia has a track record of looking out for its own interests in international relations, a policy of non-alignment Prabowo will undoubtedly retain. and a significant strategic decision in a region that is on edge over China's muscular foreign policy.
Over the next 5 years, what I can imagine is a more active president in terms of foreign policy activity. We'll see Prabowo involved more in making foreign policy decisions.
Factor in a promised big increase in defense spending, up to 1.5% of GDP by 2029, effectively doubling current expenditure. The Indonesian Military Academy graduate arguing prosperity is closely linked to security. But the strongman reputation has a darker side. Lingering concerns about Prabowo's military record and controversy over alleged human rights violations during the Suharto years have raised fears about Indonesia's political future. No surprise is the image of a jovial, dancing grandpa he now prefers to portray. Haslinda Amin, Bloomberg News.
All right, a look at markets and quite a turnaround in the last 15, 20 minutes or so. We'll unpack the story for you on the other side of this break. Don't go away. We're watching the China Show. All right, if you're just joining us right now and you are wondering why markets have turned around 1.5%. Now, we're coming off highs. We were up as much as 2% on the 8-shares index. We're also seeing some strength coming through in the Chinese currency and some China proxies like the Aussie dollar. It might have to do, likely have to do with the PBOC headlines coming through in the last 15, 20 minutes or so. To give us more context, Mark Cranfield joins us over the phone. Mark, what a turnaround from when we just spoke in the last hour or so. What do you think is going on?
Well, one thing is for sure is that investors have a high level of confidence in what the PBOC is doing. If you think back to when all this stimulus action began back in September, about a month ago, it was the first press conference was from the PBOC. They very clearly laid out what they're going to do in terms of lowering interest rates and support for the market. And what they're talking about today is specifically action to help the share buybacks in the market. And it's quite a decent-sized program as well, around 300 billion yuan to get started. And their involvement is clearly a very positive factor from investors' point of view. They clearly think that if once the PBOC is involved, the job will get done. There'll be no holding back. And that has certainly been the case so far. Everything they've said, they've done, and they're continuing to do. So whenever they speak with a lot of weight and authority. Investors take notice of it, and clearly that is helping the market quite a lot today, even though the data was pretty mixed from the GDP and industrial production and the other things that came out earlier. There will be some people, though, pointing fingers at the so-called home team, because just as the PBOC governor started speaking, there was an uptick in all the ETFs, which are usually traded by China-related funds. So yes, maybe a coincidence, but anyway, investors do like what they hear from the PBOC.
Yeah, Mark, is this going to buy us some time until we hear anything from the fiscal side of things? Because everyone still keeps talking about we need to see more of a meaningful policy pivot on fiscal stimulus in order to spark some sort of re-rating, according to Morgan Stanley, right? So at the moment, I guess you just don't fight the PBOC in some ways.
Yeah, I think that there's some truth in that. And also, investors will just have to get used to the idea that stimulus is going to take a while to come through from the fiscal side. They've started on it. It's not something that can turn the markets around overnight. It's going to be a multi-month program. But what the GDP data today reminds everybody is they can't afford to take their foot off the pedal. They've got to keep on going. They've got to continue to go ahead. But all the things they've talked about over the past few weeks all have to be enacted. They all have to be fulfilled to turn the economy around, which in turn will support the markets. There is no relaxing. They cannot afford, if they think that just because the GDP data went up 0.1% or 0.1 better than expected, or they get some other data along the road, which is a slight improvement, investors will look at that and say, well, you're still not doing enough. You need to do more. So the Chinese authorities probably have that message. The PBOC is probably going to reinforce it to everybody anyway. This is a medium to long-term strategy, but they probably will need to keep reminding people on a regular basis that they're doing it.
Mark, we got to leave it there. Thank you. Our my strategist, Mark Cranfield, they're joining us out of Singapore. We'll get you a check on markets here with Hez the next hour. This is Bloomberg.